Hello and welcome to today's episode of Third Thursday 30, the program that is dedicated to providing you the information and insight needed so that your money supports your life the way you want it to. All in 30 minutes or less. So, shall we get started? So, the subject of today's conversation is saving in the modern era. First of all, I want to enforce the fact that I'm talking about savings, not retirement savings. Part of the problem that we are dealing with as a society is in the post 401k world, our savings is all focusing on retirement, and we got to think broader than that. Okay, the changes that we are seeing in the international economic markets and such, the tax situation we talked about before, we have to be more sensitive to a broader savings strategy. And as also part of the overall push that the retirement industry has put upon us, we're going to find that we have a ticking bomb in our portfolios that we have been led to believe is going to be safe, and it's not. And so we're going to talk about that today. We're going to talk a little bit about the fallacies that are driving your current savings program. We're going to talk about how we can correct those fallacies, and more important, as it is my mission, we're not going to talk about how we can get you to save more, which is what most advisors do. No, my job is to make sure that you get to keep more, and that's what this is all about today. So, first of all, I hope you're hearing me a little better than last time, because I now have a fancy microphone. The one that didn't work last week is working now. So hopefully I don't sound like I'm talking through a tin cup attached to a string. So as the technology gets a little bit more better here too, you're going to see that we're going to do multi-site interviews and those kind of things. Because although we are talking about the finances initially here, primarily the reason I'm doing that is because I'm comfortable talking about that. And as I'm fighting through some of these issues with regard to technology and trying to get my learning curve up to place, it's a little bit more comfortable for me to be able to lean back on some of these subjects that I have been talking about for years. And the subject that we're going to talk about to start with is near and dear to me, and that is the fallacy that is modern portfolio theory. You see, folks, when I decided, it was 15 odd years ago now, to broaden my base of expertise outside of just the estate planning foundation and the business counseling foundation I started with, I took a position with a national financial planning and mutual fund firm to find out what it looked like from inside the belly of the beast. And that firm told me and taught me something that I had been taught back in college, back with my finance education, which is something called modern portfolio theory, which is what is driving your retirement savings. Okay, and picture, if you will, what it was like back in the 1950s. You had cars with absurdly large fins. You had American dominance in the post-war era. You had a nation on the ascendancy, right? You had a situation where the markets were going up, okay? Well, folks, that's the era that provides the fundamental philosophical foundation that is driving your retirement plans, okay? Now, contrast that to where we are now, when we are in a situation where we have global economic competition that is at a rate and a pace that we've never seen before. We have technology that's disrupting things right and left. That technology that has changed the way that a brokerage operation transacts its business, from being fractions of shares to decimals of shares, from guys signaling up to the rafters what needed to be done, to a situation where we now have companies that are paying trillions of dollars to have a fiber optic line that is a mile shorter than the next guy. So ask yourself if that makes sense, that is what is the basis of your retirement plan. You see, modern portfolio theory, if I talk too much about it, we're going to get bored and you're going to tune me out, so I'm not going to go too deep. But understand that that is based upon that technology, that era, and it says basically that if you keep things diversified amongst these broad asset classes, that overall, if you just hang tight over time, you will do better. Now, most of my listeners here personally experienced 2008. Many of you experienced 2000. Many of you experienced the crashes prior to that. Those crashes underscore the fundamental fallacy that is modern portfolio theory. You see, what we found out during that time is everything kind of works together. In the good times, it works well. In the bad times, it all goes down together. And that history back in the 50s, etc., where we had eras where things were going up, an ongoing bull market, then things all went up together. Modern portfolio theory holds. But when you have eras like we did back in 2008, 2000, everything went down together. And let's take a quick look at that, because it is something that you really need to understand if you're going to protect yourself in today's marketplace. So let me change here and go to PowerPointville, and hey, got a new camera too. So we're gonna really improve the experience by showing my jaw from two different angles, right? So let's talk about saving in the modern era. We're going to talk about 4 different things today. Those 4 different things that we're going to talk about are that fallacy of modern portfolio theory and diversification. We're going to talk about how we are fundamentally challenged now with regards to using bonds as part of our portfolio, where we had not had to deal with that in the past. We're going to talk about some cures for these, those cures being potentially using tactically managed funds in an appropriate fashion, and the power of indexing, which is something that we can use also to protect ourselves as we move forward into this new era. Because again, my contention is what was good in the 1950s didn't work for us throughout 1960, 1970, 1980, 1990, 2000, 2010. What makes us think it's going to work for us going forward? In fact, that theory that was designed by a Nobel laureate never has worked. And this is why. All right. So, this is an example of what's called a quilt in the industry. And what this is used to show you as the consumer is how modern portfolio theory and diversified investing can work for your benefit. Now, what this is showing is if you pick out any one of the particular colors that are up on this screen, you're going to see that what happens is that, let me ask you this. I think my screen is not showing, is it? So bear with me. We are experiencing technical difficulties as I was beginning my epic rant here. I'm going to have to talk to you about colors without showing them to you. Just a second here. You know, I used to like watching Saturday Night Live until I started actually trying to do things live myself and seeing what can happen to you when you do that. So, all right, I'm going to move on from that. All right. Sorry, folks, you get a full-on version of me again. So, what I was going to show you, and I might still try to figure it out and get this thing to work for us, is that with a quilt, as they call it, what that is that's a diagram that will show you how different market segments over the years have, in one year, been the number one in terms of return, and maybe next year it would go down to the number 2, maybe 3, maybe 5, okay? And the basic philosophy that is trying to show you is that if you have a diversified portfolio that has all of these different slices of the different market sectors, what that's going to do is that's going to give you the percentage of the winners as well as percentage of the losers. Okay, so by design, at any given year, you would have some of your stuff performing amongst the best class that was out there, and some of your stuff performing amongst the worst class. Now, that's all fine and dandy. Okay, but what that also presupposes is that each year you're going to reposition those, because you didn't want to have the good get too good. So part of that modern portfolio theory is that you're going to sell the winners each year and then buy the losers to balance out so that your overall pie chart looks the same as it did the prior year. And again, the philosophy that is driving is that if you keep those type of parameters in place, that over time you would do well. But what we had found is, again, like I said, that has never worked. Throughout the life of the market, that has failed every time we've had a serious market condition, and that has failed because, frankly, it's not designed to be used the way it has been used. See, it was designed to be used for people that were managing large portfolios that had the ability to withstand the test of time and to withstand the changes that come along with human nature. Okay, and let's ask ourselves this question: has human nature changed? No, it has not, right? You know, the fact of the matter is, when we sit here in 2019, if we have a portfolio that is built upon this modern portfolio theory allocation, we are exposed to the next time the market has a major correction. When will that happen? I can't tell you that. No one can tell you when it's going to happen. People can warn you. People can try to gin up concern, and they can try to scare you into thinking that it's going to happen soon, but they can't tell you when it's going to happen. All I can tell you is it will happen. You see, it's happened time and time again. Why would it change now? Okay, we lived it ourselves in 2000, 2008, back in the 90s, back in the 80s, etc. And the only people that are served by modern portfolio theory are the big brokerage houses, the Fidelities of the world, the Vanguards of the world, all these people that are now trying to get you as the investor to put your money into quote-unquote low-cost index funds. Now, low cost, that's good, right? Maybe. Because when you are in a low-cost index fund and in this pretty pie chart situation, then you're basically guaranteed that at some point in time you're going to lose a boatload of money. Because the problem with those indexed accounts is that they have to stay in whatever they say they are. So if it's, for example, an S&P 500 indexed account, it has to stay in S&P 500 funds. Okay? And that means that when the S&P 500 loses 50%, what have you, you're going to lose that as well. So we have to think differently. With regard to our investment policies, we're going to talk a little bit about tactical investment in a moment, but I also want to talk to you about the second thing that's driving the problems that the modern saver has with regard to saving their money, and that is the problems with the bond market. Now, we have been led to understand, those of us who pay attention to things, that the bond market serves as a bit of a protective component of that pretty pie chart. Okay, and what that has done is it has given us a situation where we have in our portfolios, not only with that pretty pie chart of the various equities that have losers built right in, we have bonds that currently are acting as losers for us as well. And I'm going to show you a little bit about that. You see, because right now we are in what has been known as a rising interest rate environment. And what I'm showing you here is simply a chart as to what has happened in the total bond market as is reflected by a ETF called BND, which is a Vanguard Total Bond Index Fund. And what this is showing us is that with a investment in that particular fund, if we were to put in our money and we were sitting here watching it, down the bottom here you're going to see this is from beginning of 2008 to 2019. And we have ourselves recovering from the crash down here when we started dumping money in, right? And then what happens when the Fed starts trying to stop dumping money in and starts tightening the money supply? Well, they start raising interest rates, okay? And when they start raising interest rates that way, what happens to a bond? Well, the value of a bond becomes very challenged when we are in a rising interest rate environment. And that's what we are seeing here as reflected in the total bond market fund here. That we had a value that topped out back in 2012, and although we've come back up a few times since then, we are well off of that value. And each time that the Fed raises the amount of interest that they're paying or charging, then the bond values are likely to go in the wrong direction. And when a bond changes its value, it can become very, very out of proportion to what you think is a small movement. And that's what I'm going to show you here. So what this is showing us is we're going to talk about what happens when we change an interest rate. So right now I'm showing you what happens with the Italy 5-year, Germany 10-year, US 10-year, Japan 10-year, France 50-year long-term bonds, if we just have the starting point being the current yield. And by the way, this is a website from the Wall Street Journal. And let's just say that the interest rate went up a half a percentage point. So what that's showing is if an interest rate went up half percentage point, that 5-year Italian bond would go down 2%, the 10-year Germany bond would go down 5%, US 10-year would go down 4%, Japan long-term, the 40-year down 14%, France's 50-year down 15%, et cetera, et cetera. So you can see for just a very small increase in the amount of interest rate being charged, the value of the bond decreases tremendously. Because you see, when we have bonds and we have stocks, or we have a situation where now we have a rising interest rate environment for our investors. So we have those challenges that the bond companies are facing trying to deliver yield for you. And we have a modern portfolio theory based allocation that automatically has losers in the portfolio. So this is why I contend that the current structure of most of your savings plans is set up for you to fail. Because you can't win enough. You got people dragging you down, and you're set up so that when the next time there's a major market correction, you're going to lose half your money. And again, who wins by this? Think about it, folks. Because I'm asked all this time, hey Greg, why is this happening? Why aren't more people doing things that I'm going to talk to you about, tactical investing? It's because right now, when you see the Vanguards and Fidelities of the world fighting over cost, trying to be a low-cost provider, it takes too much energy, too much cost to try to do some of the things we're going to talk about in just a second. So if you bear with me a second, I'm going to see if I can get my PowerPoint to work for us again here, and we're going to go back to that and see where that leads us. All right. So we're still being persnickety. I will get this stuff worked out one of these days. So as I do, I promise we're going to talk about this in 30 minutes or less. So here's what we're going to talk about next. So that's about all I have to talk to you about with regard to the modern portfolio theory and diversification for today. That could be something we go into more depth at a different time for those people who want a master class on things. But now, hey Greg, we want some answers, right? So as I mentioned, we've got two problems that we have to fight with. One is diversification and the way that that is not being done appropriately in our current investing world. And the second is the bonds and how that is not working for us appropriately in the current investing world. And what are we to do about it? So there are two solutions I want to talk to you about here today. The first solution I want to talk to you about is using what are known as tactically managed funds, as opposed to the static pie charts that I spoke of earlier. What a tactically managed fund does is it is a fund that is designed to try to find a way to get you into a position where you are capturing some of the upside when the market goes up and protecting you against the downside as much as possible when the market goes down. And so with the tactically managed account, what we're basically looking to do is look to tools that are based upon the current market environment and what's going on now and adjusting. Not just being static, we're adjusting. And what we find is if we have a properly managed tactical fund and we have a situation where the regular market is going haywire, then an appropriately managed tactical fund is going to take defensive action. Folks, isn't this what you thought you were getting when you bought a mutual fund in the first place? Or wasn't it what you thought you were getting when you were trying to have somebody manage your brokerage account? Do you get that? No. Okay. Most people find that they're not getting anything near an actively managed account. It's simply something that we're sitting on and waiting to see what happens. So tactically managed accounts try to give us the opportunity to capture as much of the upside as possible and to avoid having that downside loss. When we do that and capture some of the upside, we typically find ourselves in a much better location at the tail end of our journey. So that's one solution that we need to be looking at in terms of our portfolios. Second solution that we need to be looking at is the power of indexing. Okay, so what indexing is a tool that most people don't really understand or know about. What that tool does is it tells us we're going to have an opportunity to participate in the upside and we're not going to lose money on the downside. It is not a investment, as it were. No, it is an insurance-based product. Yeah, I know, insurance. But what it does is it gives you, as the investor, a tool that allows you to replace the risk that was in that bond and to get a reasonable expectation that you're going to get, depending upon what you're committed to, 3, 4, 5, 6%, maybe even 7% over the lifetime of that contract. And by doing that, we're able to get ourselves a replacement for that bond in our portfolio that typically had been that tool that provided us that steady baseline growth, that on top of which we would add when we have a market opportunity. So the modern investor, what they need to be looking at now is using some type of combination of tactically managed funds, perhaps some of the traditional diversified funds as well, and then throwing on top of that a layer of indexed accounts. By putting that combination together, we are able to capture a good percentage of the upside and protect ourselves against experiencing all of the downside. You know, folks, if you study history, you'll see that crashes, manias, market aberrations happen systematically, rhythmically. They don't repeat themselves, but history tends to rhyme with this. And so what we need to be doing is we need to be protecting ourselves going forward. See, the financial industrial complex is set up to make you deaf, dumb, and blind. Okay? They are not giving you good information. They are putting you into products that are suitable for them and not suitable for you. And even though some of us listen to the carnival barkers like Jim Cramer and think that we get some tips from him, or we look at some of the more appropriate sources of financial information like the Barron's, the Wall Street Journals, the Investors Daily, those kind of things, that is focusing on individual stocks. That's a game that I don't play. That's a game that you probably shouldn't be playing either. Why do I say that? I say that because by the time any of those sources bring information out to you, you need to be skeptical at best that you have any type of head start on things. You see, one of the things I do agree with modern portfolio theory is the efficient market hypothesis, which basically says that the price of the stock out there is representing all known information that the market has with regard to that stock at the time that that price is out there. And so ask yourself, by the time Jim Cramer taps himself out and says that's the buy, has all the real tailwind that's been lifting that particular position gone? Yeah. And again, human nature drives things. That's one of the big problems with the modern portfolio theory is modern portfolio theory presumes that humans act in a rational fashion. A rational human being. Yes, some maybe, but all manias have been based upon irrational actions. When you start talking to people about the water cooler, about X, Y, and Z in terms of the market, when you start hearing people talk about the latest craze, ask yourself, is that a rational human being that's talking about their finances? And when we're talking about rational human beings, wish that I was able to manage my technology better so I can show you this particular slide that I have that would tell you that with the rationality of humans in the marketplace, when we have a standard average investor, okay, their rate of return over time is somewhere around 4%. And that's because they're out of the market at the wrong times, in the market at the wrong times. So ask yourself, one, am I in a portfolio that is driven by modern portfolio theory? How do you answer that question? Well, if you look at your statement and you see a big old pie chart that's got all nice colors on it, part of it being in different market sectors and part of it being in bonds, then you are being driven most likely by modern portfolio theory. And you need to decide whether or not you're going to continue to be in that position so that the next time that the market has a major correction, you write it down. You need to ask yourself, when I am saving for my future, and again, you're saving for your future, they're not saving for retirement. Okay? The concept of retirement is changing as we speak, but you are saving for your future. And ask yourself, am I using all the tools in an appropriate fashion to give me the diversification that I need to live my life the way I want it to? Again, my charge here is not to get you to save more. My charge here is to get you to be able to keep more so that your money supports your life the way you want it to. So, if you have made it through my technological challenges here today and would like to maybe see the pictures that I was going to try to send you, a couple things. You can contact me, call us at 614-408-0004, 614-408-0004, and we can have a conversation. I do work with people throughout the U.S., so contrary to the challenges I'm having with my Facebook Live technology, I do have the ability to talk to people internationally and across the U.S. If you would like to have a copy of a leading white paper that talks about using this bond alternative that is a fixed index annuity or fixed index products, you can simply message us directly at Facebook here, and we'll make sure to get that out to you. Also with the slides, if you want those, we can do that as well. So join me again next month as I continue to learn this technology, continue to try to figure this stuff out so that I can share with you more information and insight so that you can make sure that your money supports your life the way you want it to. Have a good day.